Investors are getting set for Nvidia earnings. They're set for after the bell next Wednesday. The chipmaker blew away guidance, of course, for expectations for the current quarter in its last earnings report, saying it expected $11 billion in revenue, well above analyst expectations at the time of $7.2 billion. Now analysts are expecting earnings to jump over 300% year over year. So with the expectations this high, can Nvidia possibly deliver? Matt Bryson, Wedbush Securities Senior Vice President of Equity Research, joins us now. Matt, we all know what's going on here, and a lot of your peers on Wall Street have been raising estimates going into this report. It's a lot of weight for Nvidia to carry. Are they going to live up to this?
I don't know that it matters to some extent. So certainly numbers around their data center business have lifted substantially. At the same time, what's also clear is there is a ton of demand out there right now. It's not being satisfied. It takes 40 plus weeks to get H100 GPU from Nvidia. So they've got visibility through Q1 of next year. There's been numerous articles talking about the fact that you can't buy cloud instances. So there's just not enough supply. And so if NVIDIA's guide is a little bit light of expectations that have admittedly increased considerably, it just means they'll book more revenue in fiscal Q4 or fiscal 2025. I think the more important piece is how much demand there is out there as opposed to whether NVIDIA can bring on more supply in Q3 or Q4.
And so when we think about where NVIDIA is actually going to start to see some of this recognized within their margins, it's more than just what they were spelling out within the demand profile last quarter. When does this start to trickle through to financials? And is it already doing so?
I think it's already doing so. So I think you're seeing margins, particularly for the new H100 chips, that are well above corporate average. When you think about that data center business, it used to be relatively commensurate with gaming business. In my model right now, I've got $8 billion out of roughly $11 billion in revenue tied to data center. If that number goes higher, which is where expectations are, proportionally data center will be even higher. And so that drives more margin. And then within data center, you're seeing NVIDIA shift over relatively quickly from their old A100s to the new H100s. Again, I think that drives both ASPs and margins. And then finally, on the OpEx side of things, if you're getting these big upticks, you just can't hire people fast enough. And so you'll see leverage flow through into the operating margin line as well.
Matt, how sort of consistent is this whole switchover going to be? In other words, are you going to see sort of a big rush like we saw reflected in the guidance, and then a little bit of a smoothing out or lumpiness going forward? Or do you think it's just sort of up and to the right here, the demand that we're going to see?
I think for the next 3-4 quarters, it's up and to the right. The question comes down to you have all of the large CSPs doing a ton of work around training models. You have startups doing a ton of work around training models. The question is what comes out of that model training. So you need to see real use cases that drive substantial amounts of revenue. If those appear, then you're going to get another wave moving from training to inference. So actually running those models, and it's up and to the right for as far as anyone can see. I think there's a good chance you get a pause. So people figure out exactly what they can do with these models. And then you see a jump in inference as that functionality is realized. But it's really hard to say, that pause is going to come in Q2 of calendar 24. It's going to come in Q4 of calendar 24. And so right now, I think the focus is still going to be the up and to the right on this insatiable demand for training.
Matt, one of the other big questions I have around this trend is who else is going to start to benefit more and more as time goes on? We've seen some examples of it, right? And I know you don't cover these, but for example, we talked to a company called Synopsys yesterday that says they're now getting about 10% of their revenue tied to AI. Applied Materials, of course, talking a lot about AI on its call as well. When do we see that in the same sort of magnitude monetarily that we've seen for Nvidia start to move to others?
So I certainly think that for Nvidia revenues to start to continue to grow at these levels, again, you need these models that are being trained to generate real revenue. And so, in a sense, the customers of Nvidia's GPUs, like Microsoft and Google, and all of these startups, they need to monetize that investment. And so you'll certainly see revenue gains for them. From a supply chain perspective, it's a little bit harder. So we're seeing it in DRAM, where high bandwidth memory is really starting to take off. Right now, Hynix is the biggest beneficiary there, but Micron is certainly adamant that when we get into next year, they'll have products there. TSM is supplying all of the AI chips right now. So from that perspective, they are a beneficiary. But because gross margins for NVIDIA are so high, in part because they control both the software and the hardware ecosystem to some extent, they are really the major beneficiary here. And it's not like with other markets where you see their supply chain really benefit when a new product takes off, just because they are garnering so much of the profit.
Do you think, though, that investors need to be sort of diversifying their investments within the chip ecosystem or even with the AI ecosystem? Or do you think you can kind of like buy NVIDIA and forget it?
I mean, I think it's easiest to buy NVIDIA and forget it. So until we move, so from a scale perspective, I think it would be a home run for AMD if they're able to do $1.5 billion in AI revenue next year. Similarly, for Intel, they're talking about doing a little bit over $1 billion. When you think of NVIDIA, I mean, right now, people are looking at them doing as much as $10 billion plus in data center revenue in Q3. And then for next year, that number goes up even higher. There's literally an order of magnitude difference between what they're producing and where kind of the combination of their competitors is. And so from that perspective, if you're a real believer in AI, right now the certain thing to invest in is NVIDIA, maybe AMD as well, simply because they're, from a third-party perspective, they're probably in second place. I personally like the memory complex, but that's more because I think there's a recovery in memory next year. AI helps at the edge, but it's not the primary driver in my view.
One horse race. Matt Bryson, thank you so much for your perspective. Obviously, we'll be watching those NVIDIA numbers very closely after the close on Wednesday. Wedbush Securities Senior Vice President of Equity Research. Appreciate it.